We have 3 weeks left of regular class sessions. So we're going to take Chapter 12, Part 1 this week, Part 2 the next week, and then we will finish up with Chapter 11. Okay, we got 3 big items for our big finish. Well, first of all, we've dealt with the amount realized. All right, so when you have a disposition of property, the first thing you do is the math to determine whether or not you have a gain or loss realized. And then recognition, we haven't talked too much about that, but we will do that in the next couple slides. To recognize means that the gain or loss realized, which is just the math, is actually going to have an impact on your taxable income. And then when we start the second half of Chapter 12, we will broaden out to our last concept, which is characterize. And the ultimate goal of characterization is to determine whether or not you have ordinary income that will be taxed using the marginal tax rate schedules, or if you have a capital gain or loss, and if so, is it entitled to special tax rates. And you will see that the concept of how to do that is very similar to qualified dividends. It's just there are several different rates that you can choose from. So we are going to define what capital assets are in this section. And then we're going to deal with capital gains and losses. We'll determine net capital gains and losses. We will talk about the tax rates relating to the various capital gain and loss positions. And then we'll save the rest for Part 2. Out on Blackboard, there is a recap sheet that will cover the next 3 or 4 slides. So if you are tired of looking at little scrunched up stuff in class, when you print out the PowerPoints, you can refer to that. It's a Word document, and it might be easier for you to use as a kind of reminder. Not a formal checklist, but definitely a list of all the major concepts that you need to worry about. So in Chapter 10, we dealt with realized gains and losses. All right, and we determined that the amount realized was any money you got, the fair market value of any property you received, the fair market value of any services you received, and any debt relief. Right? And we also very briefly discussed adjusted basis. That you may get property by purchase, in which case your basis is what you paid for it, increased by capital improvements, not repairs, reduced by cost recoveries. And then we talked about inherited property and property you received by gift, property that you convert from personal to business use. Those are all fairly unique subjects. Going forward, we will primarily simply be using a cost basis. I will tell you what the basis is. I will tell you if there is any accumulated depreciation. But your money shot to get started will be to take the amount you get is the amount realized minus that adjusted basis to get to your gain or loss realized. Remember that when I say realized, that's just the basic math until you move on and determine whether or not you recognize that gain or loss. You don't have any idea of what the impact will be on your tax return. So what do we mean by recognized gains or losses? Well, I have a list here. The most important thing is the type of property, and I don't necessarily mean whether it's a car or a house or stock. I probably mean more how the property is actually being used will control recognition. So you'll never recognize a loss. That loss is gone forever if it's your personal property. So if it's the car that you drive back and forth to school, if it's the novel you were reading the other day, the necklace that you purchased, those are all things that you probably did not purchase with a profit motive. And now if you buy the Hope Diamond, we'll come back and have another conversation. But if you spend a couple $100 for a piece of jewelry, the government's going to consider that to be personal property. If you have a loss, when you sell it, you're not going to be able to recognize that loss. No, there's always exceptions, right? In our last set of slides, in addition to Chapter 11, we are going to talk about casualty losses. If that jewelry gets stolen from you, if all of your reading books get burned up in a fire, there is a potential for you to take a casualty loss deduction. It is a Schedule A item, and so it would be treated as an ordinary loss if you got there, and it will reduce only if you itemized your deductions. But that'll be coming up in our final set of slides. A related party sale, when you sell to your corporation or to your brother-in-law, there are going to be restrictions on when you can use that loss. This will be a big topic in your corporate class because there's a lot of transactions that happen between an individual and the corporation. For here, all you need to remember is that if I say you sold to your brother or to your corporation, you don't get to use your loss. And then depreciated property, this is not the property that has declined in value. It is property that is subject to depreciation. There is a potential for you to want to sell your depreciated property to somebody else and buy back similar property so you can get a larger basis. And so there's simply restrictions on sales of property subject to depreciation. If you have a loss, we'll stay away from all those special rules. So we won't worry about that at all. And then below fair market value sales, that simply means that you give someone a bargain purchase. Something's worth $10,000, but you sell it for only $5,000, generates a loss to you. Usually what's happening there is you are trying to give something to a related party, or you are trying to give something to charity, but get something back, not give them 100%. And so there are restrictions on recognizing losses there. So of this list, and one more, like-kind exchanges. Right? If like-kind exchange, we will define in Chapter 11. When you sell or engage in a like-kind exchange and have a loss, you will not recognize that loss. So we'll stay away from the depreciated property and below fair market value sales. Just be aware that there are times when taxpayers are trying to be clever, and that can come back to cause them issues. And so the tax code simply says we're not going to let you recognize losses in some situations. And the wash sale, but we've dealt with it already. You know that if you sell your stock at a loss and repurchase substantially identical stock plus or minus 30 days from the date of sale, you do not get to recognize that loss. Not being able to recognize your losses is a sad thing. Not having to recognize your gains is a good thing. So you won't be surprised that the list of non-gain recognition items is a whole lot shorter than the prior slide. Now this material is discussed at length in Chapter 11. So this is just kind of an overview. All right, your principal residence, you can only have one principal residence. If you sell it under the right set of circumstances, you can exclude, and exclude means it goes away forever, all of the gain inherent in that. There'll be a short summary of that on the fact sheet as we move into our last client letter, but the actual math and everything we will defer to Chapter 11. And then an involuntary conversion, also discussed in Chapter 11. Instead of an exclusion, you're getting a deferral, which means that eventually you will have to pay the taxes, but later is better, right? So an involuntary conversion is like a casualty in the sense that something has burned down, blown down, been stolen from you. The difference is that your insurance reimbursement exceeds your basis, so there's actually a gain. But once again, we'll discuss that at length in Chapter 11. And then like-kind exchanges, again, the flip side, if you have a gain on a like-kind exchange, you will defer that gain unless you received boot. And boot simply means something that's not like-kind. So those are topics we'll discuss in Chapter 11 as we're wrapping up the course. So once you've determined whether or not you're going to recognize gains or losses, your last job is to characterize gains and losses. All right, and once again, the type of property controls. 1221 property, that's the capital assets. We're going to cover that in Chapter 12, Part 1. And so we're focusing on whether or not a property generates a capital gain or loss and the consequences of that. A big part of Chapter 12, Part 2 will deal with this 1231 property, and it's kind of a hybrid. When you finish Part 1, you'll know that if I net to a capital loss, this is also a sad thing because there's a lot of limits on my ability to use my capital losses. And so the government created a type of property that will reward you with capital gain treatment if you make money, but allow you to have an ordinary loss treatment if you lose money. And so that's what we call a 1231 property, the best of all possible worlds. It's a pretty complicated code section, so we'll leave it until Part 2. And then if it's neither 1231 or 1221, it's just ordinary income property, and it generates always ordinary gain. And we'll put all these pieces together as we get into Part 2. For now, we just want to concentrate on 1221 capital gains properties for this section. For the next couple of slides, we're first of all going to define what a capital asset is. And then I've got a couple slides on special issues. We won't spend much time on them. Just treat them as deep background. If you're going on to take your corporate class, they may be important there. So when Dr. Edmonds says, you've never covered this material, you want to say, oh, maybe we had some vague introduction to it, but why don't you tell us about it? So we got a code section. See that little squiggly? Code section 1221. It defines capital assets. It's not a particularly useful because the bottom line is almost everything is a capital asset. So you know that it starts out saying all assets are capital assets except, and we've got a list here. So don't focus on whether it's a car. Focus on how the car is being used, because if it's being used in any of the bullets that are coming up, it will not be a capital asset. All other uses of a car will create a capital asset, but that doesn't necessarily mean you'll have income recognition. Remember, because your car that you use personally is going to be a capital asset. If you sell it for a loss, you're out of luck because you do not get to recognize that loss, right? It doesn't get to play at all. And so not all capital assets are treated equally. And so once you've defined something as a capital asset, then you have to delve down a little deeper to get the final answer, please. So inventory, those things that you hold out for sale to your customers, will never generate a capital gain or loss. It is always ordinary income generating ordinary gains or losses. And then note the second bullet simply relates to factoring your accounts receivable. Sooner or later, you're going to deal with the fact that I need some ready cash. I've got some grade A accounts. And so rather than wait for them to pay me, I'm going to go ahead and sell them to another party for 98 cents on the dollar. Since the inventory generated ordinary income to begin with, that factoring generates a loss, right? A 2-cent loss. The government did not want that loss to be called a capital loss. As I noted earlier, there are restrictions on using your capital losses. And so the second bullet simply gives parity between the ordinary income recognition for inventory and any potential losses you might have because you sold them to a broker to get money faster than waiting for the client to pay you. The third bullet is a pretty complicated one. Depreciable, that's property subject to depreciation, or real property, that's land, used in a trade or business, is probably Section 1231 property. There's a caveat to that you must own them for more than a year. We're going to spend a lot of time in Part 2 of Chapter 12 on this. Just note for now that any property subject to depreciation or any land used in a trade or business, and this is the one place where rental properties are subsumed under trade or business. Remember, rentals are not a trade or business. They're a Section 212 activity. However, for the purposes of the depreciable property not being a capital asset and potentially being a 1231 asset, this is the only place in the entire code that I know of that where it says trade or business, it means this includes rental property. So depreciable or real property used in a trade or business or a rental will never be a capital asset. It will be an ordinary income asset or a 1231 property. And we'll talk about that more next time. And then copyrights and creative works. This is Stephen King writing the great American novel. He's banging away at his typewriter, but he produces something that he sells. And so just to make it clear that the clerk working behind the counter in the bookstore owner, and Stephen King writing the book all have ordinary income as a result of getting rid of the books. So any copyrights, any creative works, anything that's intellectual property that is in the hands of the creator. All right, so Stephen King sells his copyright to a publisher. That publisher now has depreciable property. So the publisher now has that the third bullet here, because amortization is just a form of depreciation, right? Less bells and whistles, but it is a cost recovery. And so the publishing company has a potential 1231 asset. On the other hand, if for some reason the copyright is just a beautiful piece of paper and you buy it from Stephen King as an investment, you're simply going to hold it over time so that you sell it at a profit later. That would not be inventory, because it's inventory if you're holding it out for day-to-day sell. So we're going to see on the next slide that a broker owning stock has inventory, but a broker who's investing for retirement has a capital asset. So if you're holding something for long-term potential growth, that's not inventory, and so that will be a capital asset. And then the last bullet here is just to keep you from selling your Pub 17 and calling that gain a capital gain, and to keep our presidents from having big charitable contributions when they set up their libraries. Because the first thing that Obama is probably thinking about over the next couple years is where his library is going to be, probably Chicago, and who's going to contribute to the fund. And as he gets ready to pack up and get out of the White House, he's going to have great big boxes of keep this, give it to the library, keep that, give it to the library. And you may remember that back in many weeks ago, if you give property to a charity and you give it under the right set of circumstances, you get to deduct fair market value instead of the cost property. So the fair market value of any document signed by a president is a whole lot more valuable than just the piece of paper that it's written on. And so you would say, I have a bunch of capital assets, because it's not inventory, right? That I want to take a fair market value deduction. And this provision simply says, no, this can never be a capital asset. And so you can never take that step up for your charitable contributions. Not a big deal, but an interesting comment if you're making cocktail conversations as Obama gets out of the White House. So I said special issues. What's the first one? Dealers and securities. I alluded to that. If you are a broker, you may own stock to sell and you may own stock to put in your retirement plan. Every time you buy stock, you must declare at the date of purchase whether it is inventory or part of your retirement. You don't get to hold it and see which way the wind blows and then decide whether or not it is an inventory asset or a capital asset. And then real estate and timber have some really strange rules, and we're simply not going to go there. But you can get some things that really look like I'm selling inventory that get treated as capital gains. And then non-business bad debts, we'll discuss them briefly. I I think maybe stuck in the back of Chapter 11. They generate short-term capital gains for individuals, non-business bad debts, short-term capital losses, not gains. All right, now we're going to get into the math, the nitty-gritty of capital gains and losses. First of all, we have to have a sale or exchange. We'll discuss that briefly. Then we'll talk about the holding period that differentiates between long-term and short-term. We'll talk about the tax rates. And then we'll talk about how corporate taxpayers differ from individual taxpayers as these rules are applied. All right, the recognition of a capital gain or loss generally requires a sale or exchange. If you just walk away from property, that's an abandonment, and those rules can be a little bit different. The code doesn't determine sale or exchange, but whether or not you've abandoned it or sold it or given it away gets litigated and got all the way to the Supreme Court. And the Supreme Court, in its most useful, said it means what it normally means, that everybody should know what a sale or exchange is, just as they should know what pornography is, right? Something that's not definable does not mean that it should not be commonly recognized. But sometimes people still argue about whether they're entitled to a capital gains treatment or it should be ordinary treatment. But we won't go there. Just a little bit of background. The holding period is important because whether something is a long-term gain or loss or a short-term gain or loss has a dramatic impact on the tax implications. So the holding period runs from the day after to the trade date. So you can't count both the day you bought it and the day you sold it, which is the short story there. It's usually not important unless you have had a fairly short holding period. You're trying to get to long term, and you need enough days to get what is currently over a year. And so if you buy it on January 1, you can't sell it on December 31 and have held it for more than a year, because you will not have even owned it a year, much less more than a year, because you can't count both January 1 and December 31. Doesn't happen very often, but it occasionally can cause some issues. The code states that the holding period has to be more than, so currently you have to have it more than a year to have a long term. Long versus short have had various definitions over time. At one point, for a very short period of time, 6 months was treated as a long-term holding period. Currently, and for the last 20 years or so, the holding periods are what is stated on the next slide. So let's go there. So your holding period, short term, is less than or equal to 1 year. Long term, more than 1 year. All right, so short term gains, capital gains, are essentially going to get treated just like ordinary income. Nothing good's going to happen. Long term is what gets you the special tax rates. And for losses, it doesn't matter whether they're short term or long term. If you have a net capital loss, we've got slides coming up to say that is not a good thing. So we have 5 tax rates for capital gains for individuals. And note, this is just for individuals. We'll talk more about the differences between corporations and individuals coming up. The first thing is these 5 tax rates interrelate, and they can be extremely complicated to do the math. We will not deal with all 5 of them at the same time. All right, so we'll deal individually with the tax rates as a problem-by-problem basis. So net short-term gains are treated like ordinary income. Net long-term gains that are not collectibles. I've got a slide coming up. Collectibles are things that you buy to hold because you think the next guy is going to be crazier than you are, and he'll pay you more for that sunflower than you paid, not because you think the business is going to grow and make more money. They have a 0 rate if your marginal tax rate is 10 or 15%. So what we're seeing here is exact same rates for net long-term gains that aren't collectibles as you see for qualified dividends. So this should be comforting because you've seen it before. You've dealt with this math since the very first week. 15% if you're in that 25 and 35% brackets, and then the 20% if you're those guys at the top in the 39.6% bracket. And just a note here that those rates between 2008 and 2012 were different. In 2013 is when we got the 20% rate. Collectibles are taxed at a flat 28%. So that means that if you are a normal human being and your tax rate is 25% or less, having a collectible, holding it long enough to get it to be long-term is not going to do you any good at all. And remember, these are the maximum rates. So if you were in a 10% tax bracket and you sold all of grandma's silver, you would get your 10% and 15% tax rates. You wouldn't automatically jump up to 28%. But because it was something that was simply held it will make more money over time because people are crazy versus because the company did better, you will not get your 0 tax rate. And then there is a 25% tax rate attached to some gains from real property. We'll talk about that more in part 2 of chapter 12 after we have dealt with a couple of other issues. We'll bring the 25% tax rate back at that point. And because we have to unrecaptured depreciation deductions means absolutely nothing at the moment, but hopefully once you finish chapter 12, that will. The next set of slides are simply going to show the math on 4 of the 5 different rates. We'll save the 25% rate until the end of part 2. The math here is identical to what you do with qualified dividends. The only difference is determining what the tax rate is. So we'll focus on determining what rate you use. I'll show you the math at the bottom, but we're not going to spend a lot of time on the narration. If you're still struggling with how to carve the preferential income off the top, do your normal tax calculation and add it back at the required rate, you can either go back for detailed narration from chapter, it must have been chapter, what was it? Oh, the intros chapter, or you can just do the math again. Just read the examples and do the math. Identifying the tax rate should be the only thing that's complicated here for any of you. So a single taxpayer, that 105, that's the same number we used before. That makes him in the 28% tax bracket. Taxable income for 2013. If all of that income is ordinary income, you would simply do a normal vanilla tax calculation, just like we've been doing since the very first class. And just as a reminder, those tax rates, that little excerpt for the 28% on the next slide. So I am confident that every one of you can do a normal vanilla tax calculation on these facts. If you're struggling at all, you can always pause the slides and go back through the math. But make sure that my confidence is well placed and that you can do the basic tax calculation before you move on to the rest of the slides. So note here that if I had told you that the $105,000 was all short-term capital gains are taxed like ordinary income. And so once you net positive with your short-term gains, nothing good happens. Treat them like bank interest. Throw them back into the ordinary pot and do your normal tax calculation. So the preferential rate on capital gains, let's try the rich guy. Marginal tax rate in the next example is going to be 39.5%. So this guy's got lots of income. We know that his qualified dividends will be taxed at 20%. If he has any net 1231 gains that are not from collectibles or relating to that 25% rate, his tax on those on the capital gains will be at 20%. And if it's a collectible or it is the real estate 25% rate, I have to give you extra facts, right? So if I just tell you that there is a net long-term capital gain that will just be the vanilla 0, 15, or 20% rate. If I want you to think about the other two issues, I will flag it with facts that make it clear that it's not just selling stock or something. All right, so taxable income over $400,000 is taxed at 39.6%, and the cumulative rate below it is this 116 for a single person. So we don't even need rate schedules for this. All right, so if this was all ordinary income, you'd have simply taken the 400,000 from the 605, multiplied by the 39.6, and added this nice big number here, and that would have given you the tax. Because $10,000 is a net long-term capital gain, it's going to be going taxed at 20% instead of the 39.6. And so you have a tax calculation that is very similar to what we did with the qualified dividends. And in fact, even if I had said the 10,000 was qualified dividends, the math would be exactly the same. All right, and if you were between 25 and 35%, the calculation would have us paying the tax at 15% instead of 20%. So the slide that I wished through real fast was just the rate schedules. You can go back to there or get out your book, whatever you need to make sure you know how to do the math. So this is the answer you should be getting, slightly smaller than you got when it was all ordinary income, because 10,000 instead of being taxed at 28% is going to be taxed at 15%. So here's your math. Let's move on to collectibles. Remember, the preferential rate for net long-term gains from collectibles is 28%. So effectively, if your marginal tax rate is 28% or less, you have no preferential rate because there's nothing to carve off and multiply by a rate that's less than your marginal tax rate. Same facts, 105 of income. 10,000 is now from the sale of a collectible held more than a year. What is the regular tax liability? That answer is the same as if there were no net capital gains. I've gone through the formal process of carving out the 10,000, but since I'm multiplying it by the same thing I am using as the highest marginal tax rate, it's the same as if I ignored the collectible completely. Different story for people at the top. If you are in the 35 or 39.6% tax brackets, you will get a preference for your collectibles. Not as great as your stock, but still it's better than nothing. Same facts as earlier. Here's our income. 10,000 from the sale of collectibles. Taxable income over 400,000 is taxed at 39%, and there's the cumulative for you again. So calculate what the total tax would be if that carved out 10,000 is multiplied by 28% instead of 20%. And there's your answer, and there's your math. There's a pretty serious political divide between those people who think preferential rates on long-term capital gains are good for the economy and those who think they're just a boondoggle for the wealthy. Remember, it's pretty easy to have a capital gain. All you need is grandma to give you her diamond ring and you to turn around and sell it, and you could very easily have a capital gain. But to get a tax benefit from that capital gain means you have to have the right tax position. So prior to 1997, that position was if your marginal tax rate was not greater than 28%, net capital gains or preferential rates did absolutely no good for you. So about then, those people who are in favor of preferential rates wanted to move the top rate down to 20%. And in order to do that, they had to placate the people who said the small guys are getting nothing out of this. And so they reached a compromise where for the 20% for the people at the top, there would be a preferential rate at 5% for filers in the 10 and 15% tax brackets. And at that time, of course, remember when they changed the law, the CBO has to do markup of bills and figure out what they cost. It was too expensive to let all of the income that was being taxed at 28% drop down to 20%, while at the same time giving the people at the bottom a break. And so that's why they left the collectibles behind to be taxed at 28% to make the math work. Because remember, putting money into the stock market presumably builds the economy and creates jobs. Buying a sunflower and turning around and selling it for $1 million profit generally only benefits the taxpayer and his broker, right? So the economy's not growing just because people are crazy about what they pay for sunflowers. So there's no true economic benefit there. And so it was easy to leave collectibles behind. And then that's also how we got that 25% tax rate that we'll talk about at the end of the next set of slides. It was just too expensive to give everybody the 20% rate. So long-term capital gains, the short story is if you have the right kind of long-term capital gains, defined as not collectibles, not real estate portions, all filers will have a preferential rate. So remember, the collectibles don't count. The 25% on real estate doesn't count. If you're in the 10 or 15% marginal tax rate, gains are taxed at 0%, just like the qualified dividends work. So this slide just does the ordinary income for someone who is in the lower brackets, who has nothing but ordinary income. So you can see the math here. I didn't even slow down for it, because by now, if you did need any practice during regular tax calculations, you should be totally up to speed. So if you're still struggling with it, could cost you something on the last couple tests, so you may want to get it straight. So remember, if they had been short-term capital gains or capital gains from collectibles, or for some reason this poor person sold real estate, this calculation would be what you would use, period.